this video, I'm going to tell you how tax write-offs work for your business because they are the easiest way for any profitable business to pay less tax. If you're new here, I'm a qualified accountant with over 10 years of experience working in the tax profession. This video is part of a new tax basics series covering things like how to be more tax efficient and how to do your own tax returns. So if those videos would be helpful for you, then don't forget to hit the subscribe button. In this video, I'll talk about what a tax write-off is, what the law says, and what you can claim. I'm also going to cover some more unusual deductions that people have claimed, so make sure you stick around to hear about that too. First of all, let's talk about what a tax write-off is. A tax write-off is also referred to as an allowable expense or a deductible expense. I'm going to refer to them as allowable expenses from now on because that's what you will hear your advisor saying. So in the UK, you can deduct the costs of running your business from profits before tax in your P&L. But for tax purposes, not everything that you can deduct from your accounting profit can be deducted for tax purposes. Those costs that are not allowable for tax purposes have to be added back when calculating your taxable profits. It's important to make sure that you're getting your allowable expenses correct so that you make sure your business is paying the right amount of tax. So you want to make sure that you're claiming all of the allowable expenses that are available to your business so that you can minimize your business's overall tax liability legally. But it's also important to make sure that you're not claiming expenses that you're not allowed to claim because that will have HMRC asking questions into your tax return. Now let's cover off what the law says about allowable expenses. So there are two things that you need to consider when asking if an expense is allowable for tax purposes. The first is the wholly and exclusively test. The legislation only allows costs that have been incurred wholly and exclusively for the purposes of the trade to be deducted from taxable profits. So if you ran a business like a wedding cake business, costs that were typically considered to be wholly and exclusively for the purposes of that trade would include things like the ingredients for your customers' cakes, the aprons used by you and your staff, product liability insurance and any other insurances that you need, and the energy costs needed to run your ovens. Of course, there are lots more as well. This is just an example. And the second thing you need to look at is the capital versus revenue test. The tax legislation says that capital costs cannot be deducted when calculating taxable profits. Only revenue costs can be deducted. Capital isn't defined in legislation. Instead, previous case law is looked at to decide whether something is capital or revenue in nature. One of the things that has been said in a previous case is that capital expenditure usually results in an asset that provides an enduring benefit to the business. That would typically involve the acquisition or modification of an identifiable, tangible or intangible asset. So in the example of the wedding cake business, if you bought a new oven or KitchenAid mixers to make your wedding cakes, they would all be examples of capital expenditure because they've resulted in the acquisition of identifiable assets that will produce an enduring benefit for the trade. So that means that a revenue deduction wouldn't be available for those assets, but instead something called capital allowances would be available, but I'll discuss that later on in the video. Now let's go through some more examples of allowable expenses. So there are some standard allowable expenses that most businesses will claim, and they include costs like rent and utilities of your business premises, stationery, printing and postage costs, the cost of materials. So for the cake making business we spoke about, that could include the cost of cupcake cases or greaseproof paper or ingredients for your clients' cakes. Also, accountancy fees and marketing fees will typically be deductible for most businesses. I wanted to mention some unusual things people have written off here because it highlights the importance of thinking about the business that you have and what costs are essential for you to conduct that business. So recently there was an OnlyFans creator who deducted the cost of their breast enhancement from their taxable profits. And they managed to convince HMRC that this was a legitimate business expense that they needed to do for their business, and HMRC accepted that as an allowable expense. HMRC currently does have a concession that allows self-employed performers and entertainers to deduct the cost of cosmetic surgeries from their taxable profits if they are essential for conducting their business. There was another person, a radio presenter who was unnamed, who claimed the cost of straightening their teeth under the same concession, saying that they needed to do that in order to land a TV role. So these are unusual examples, and HMRC don't have many of these concessions, but it just shows that there are some unusual deductions that people try to take from their business, and sometimes they are successful. But that doesn't mean that HMRC won't raise lots of questions if you try and do something like that. And there are some things that you won't be able to deduct in your tax return that your tax advisor should know about, but you might not know. So first of all, client entertaining under Section 45 of the Income Tax Act 2005 is not an allowable expense. So if you take a client out to dinner, even if you only discuss business, that is not deductible from your taxable profits. It would have been deductible when calculating your accounting profit, but for tax purposes, it does need to be added back when calculating taxable total profits. Business gifts. These are treated in the same way as client entertaining in that they are not allowable for tax purposes. The only time that gifts are allowable is if they show your business name, they cost under £50, and they are not food, drink, or tobacco. So if you gave your clients a pen with your business name on, that would be fine and it would be allowable for tax purposes as long as it wasn't a Mont Blanc pen that clearly costs more than £50. If you gave all your customers a bottle of wine at Christmas, that would not be allowable for tax purposes. Depreciation. Depreciation is not allowable for tax purposes. Even though it's an expense in your P&L, it will be added back when calculating taxable total profits, and instead something called capital allowances are available on qualifying assets, and capital allowances can be very generous. So there is something called the full expensing rules, which means that certain qualifying assets can receive a 100% deduction from taxable total profits. So the ovens and the KitchenAid mixers that we spoke about earlier would be capital items of expenditure, and they would not be deductible in your company's tax return, but instead they could qualify under full expensing and they could receive relief under the capital allowances rules. So you could actually receive a 100% deduction under these fixed asset rules instead. Now let's talk about how to record write-offs. HMRC expect you to keep records of all money that's been spent by the company, all money that's been received by the company, and then any other business records like bank statements and important correspondence. You need to keep these records for at least 6 years from the end of the company's last financial year. Having an understanding of tax write-offs is important whether you're doing your own company tax returns or whether you have an advisor doing them for you, so that you make sure you capture and record all of the expenses that you could potentially deduct from your company's taxable profits in order to keep your business as tax efficient as possible. I hope this video was helpful. If it was, then please do subscribe to the channel and I'll see you next time.